Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. Global stocks are mixed ahead of the Federal Reserve's final rate decision of the year. Kevin Hassett suggests there's room to cut more than 25 basis points. JPMorgan shares close lower after its higher cost warning. What read across does this have to the rest of the banking sector? Plus, sources tell Bloomberg that Elon Musk's SpaceX is moving ahead with plans for an IPO next year, targeting a valuation of $1.5 trillion. We bring you our Bloomberg scoop.
OK, here we go. Big day, Fed day. What are we looking at in terms of the markets? US Stocks 50 futures down. Actually, US futures are fairly flat right now. A little bit to price in from yesterday. This is the number that I'm really watching out for. 4.1781 is where we are on the US 10-year. Where are we going to be by the end of the day? Could we get to 4.2? Does a hawkish Powell get us to 4.2? Does the dot plot get us to 4.2? How many more rate cuts could there be? Trump wants a lot. The market's not quite so convinced. 4.1781. Which way does that go for the rest of the day? Silver's amazing. Look at this. We're north of 60. We're north of 61 now. We're up by another 1.12%. That speculative trade continues to power ahead. We have a lot to discuss. It is the Federal Reserve's meeting, day 2. Day 3 comes tomorrow. The countdown to the opening trade starts right now.
We're checking this. You know, we have a bad head of the Fed. Bad. We're going to be making a change. Fortunately, this guy said. But we have 4 members appointed by Sleepy Joe Biden.
Trump wants rate cuts. The market doesn't feel quite so convinced at this point in time. Yes, equity markets would love to see a rate cut, a dovish cut today, signalling that there are more to come. The bond markets may be painting a different picture at the moment, and you do wonder ultimately where we're going to end up. And is Hassett going to get the job, or is somebody else going to? There's so many questions surrounding the Fed. Yeah,
so many questions. And President Trump previously has sounded pretty convinced that Kevin Hassett was going to get the job. In the most recent comments he's been making on the subject, he says he's got a couple of people in mind and he's going to decide soon. So we still don't know, but is the field a little wider open than we thought? Maybe not. We'll wait and see. What kind of dissenters are we going to see at the Fed today? Are we going to see dissenters for a hold? Assuming there is a cut, do we see dissenters for a hold and dissenters for a bigger cut? And where does that leave the Fed? Kevin Hassett, of course, has been quite vocal, being asked, of course, a lot about what he would be doing in this situation. And he does suggest that there would be room to go further than 25 basis points.
4.2. Are we going to get through 4.2 on the US 10-year? The market is also looking at the data. And certainly you looked at the JOLTS data yesterday and it signaled stabilisation within the labour market. What happens if we don't have to worry about the labour market? What happens if inflation comes back onto the table in terms of a risk for next year? We'll debate this one with Val a little bit later. But there are so many kind of risks around the dual mandate at the moment, and what it is, which side of that dual mandate we should be focusing on. And it's really hard with the data at the moment to make a clear judgment on that. But the market is clearly slightly nervous about overly aggressive rate cuts at this point. And some are suggesting that actually where we are now, this should be the last rate cut.
Right, yes. And that ties in with that conversation we've been having about how the bond markets are not really reflecting what the Fed is saying they're doing. So we'll see what the Fed says it is likely to do with the dot plot today, and whether that then gets priced into markets or whether markets say, no, we don't think you'll be able to cut that much. We think inflation's more of a worry. When asked about where his loyalty lies, Kevin Hassett, is it to his economic independence or is it to the president? He said, it is to my independent economic judgment, but the president trusts that, as if trying to create a nice loop around the whole lot. It just feels as if
there's been a slight tone shift, though. A few days ago, it was like, I'm down to 1. He's in the room. Hi, Kevin. How's it going? Like, nice to see you. So everybody's like, yes, it's Kevin Hassett. But the last couple of days, and I think it was the FT that broke the story yesterday, talking about the idea that actually he's still interviewing people. They're still interviewing and talking to people. Walsh is still on the list. Rick Reeder's still on the list. There are other people that could potentially get the Fed job, despite the fact it feels like it's Kevin Hassett's at the moment. And you wonder what is going on behind the scenes. Is it the Senate Banking Committee pushing back and going, we don't think Hassett's your guy? Is it the market pushing back and going, we don't think Hassett's your guy? And I'm just wondering where this very subtle but quite significant tone shift is coming from.
We will see, and we will see when we get that news what it does to the market's thinking around rates. Let's talk about the banking sector, of course. Very crucial to the Fed conversation. Concern about costs is the new worry for the banking sector, it seems, and certainly JPMorgan commentary by Marianne Lake, who runs the consumer banking side of the business. That's what caused a drop in the stock yesterday, just after European close, so in the US session. But what's interesting to me is she's saying that the costs are rising because of volume and growth-related expenses.
Sure.
So some of that's
AI
around...
is on the list as well.
AI is on the list as well, but some of it's around increasing branch building, which seems interesting. But you wonder how much of this increase in cost is also going to come along with an increase in revenue if it is about volume and growth.
So I'm fascinated. I looked at the JPMorgan charts, and it struck me as odd that JPMorgan was the one that fell. Now, I understand that the initial market reaction is JPMorgan has higher costs, therefore it's going to be able to deliver less money to shareholders. But the rest of them, this is JPMorgan. This is the gorilla in the room of global banking. And if it is spending more, that's bad news for everybody else. JPMorgan has got the balance sheet, the revenue lines, everything to be able to support this kind of spending. The rest of the banking sector, less so. Yeah. So I think this is bad news for JPMorgan. It is terrible news for the rest of the global banking sector.
Yeah, does it read across into the rest of the global banking sector? We'll certainly keep an eye on London banks. And speaking of London banks, one way to reduce your costs if you are a global business, if you are listed in London, or listed anywhere, in fact, is to remove co-management roles. And we have a great story. HSBC CEO Slattery speaking to Francine, talking about how it's taken 15 months of transition, but he's now got rid of these co-head roles, which he really didn't like. I thought it was a nice reminder to me, though, that he was co-head of global banking himself previously. But anyway,
co-presenters. Do we need to just? Would it be? I think we need another one. But
yes, we do. We need three of us. We need more. It's a totally different story when it comes to presenters. So they've gone from a situation where 0% of their revenue fell under single accountability to now 60% under single accountability, and he sees that as a better thing for the business.
Let's stick with the theme of bankers. Bankers are very excited. Going into next year.
Deals.
Because they think that there's going to be lots of deals. Lots of debt deals coming through. We've seen that certainly with the Warner Brothers, Paramount, Netflix saga that is going on currently. And there's an awful lot of debt coming down the pike as a result of that. So if you're in the origination business, fantastic. If you're in the IPO business as well, apparently next year is going to be a great year as well. And apparently, we wrote a story on this the other day, there is a big pickup in IPO activity going into next year. And there's these giants that everybody's waiting to see which one is going to be the one that kind of kicks this all off. And we now think it's probably SpaceX.
Yes, middle to end of next year. 2026, an IPO for SpaceX that would value the business at $1.5 trillion. That's trillion dollars. And you're right, there is a lot of excitement around this story in particular, but also what this signifies. I was drawn to some Goldman Sachs comments. The CFO yesterday saying that the 2026 deals roster is likely to be the second biggest year in history. There's a lot of PE deals finally coming to the table.
But there's also... Yeah, and they're big deals. And this is the difference. A lot of these companies normally, historically, I should say, would have IPO'd a lot earlier. But they haven't, because they've used private money to build their balance sheets in the way that you normally wouldn't. So they're coming to market with the kind of valuations, as you say, like for SpaceX, just enormous. Yes. They're going to raise 30 billion. They're going to have a valuation of north of these are huge companies that are coming to market with a completely different profile.
Right, so this is IPOs and this is deals and all of that. We're getting some sizable numbers attached to it. Space-based data centres, anyone? That's now a thing.
So, OK, this is interesting. So I had a conversation with Blue Origin the other day at the Dubai Air Show, and they're talking about living off the land on the moon. So what they're going to do is go to the moon, and they're going to, I think it involves some sort of electrolysis. They're going to use electrolysis and all the silicon that's on the moon, apparently, to make solar cells and then make chips and do all the other things. So SpaceX isn't the only one that's kind of potentially talking about this. So, yeah, they think they can live off the land. And one of the byproducts of that would be oxygen, et cetera, et cetera.
Well, this is a slightly different take on SpaceX. What they're doing is, space-based data centres. Apparently, you don't need fresh water if you do it in space. So that
because
reduces,
the cooling. You have the whole cooling factor. You can make the cells in space. Apparently, you don't need to ship them up there. You can create an ecosystem.
Doing something similar. So
amazing.
There we are. New frontiers.
Well, yeah. The moon. Apparently, landing on the moon, there's a problem. It's a very sort of uneven surface. Anyway, what have we got coming up today? Back to Earth. Florian Nielpo, a Lombard Odier macro head, is going to be joining us to talk about the Fed. Mark Winterhoff, Lucid Motors interim CEO, is going to be joining us. How big an opportunity is there in the EV space for Lucid here in Europe? Helen Jewell, BlackRock International CIO of Fundamental Equities, joining us around the table. And Domhnal Slattery, Vertical Aerospace, its chairman. They're making a big announcement today. You're going to be able to go from Canary Wharf to Heathrow quickly, and Gatwick and shopping centres and all kinds of exciting places that you may want to go very quickly by 2028.
Let's tell you what else is on our agenda today. Then 10 a.m. UK time, Rachel Reeves will be testifying to the Treasury Select Committee. We heard a lot from the Bank of England yesterday. Today is the turn of the Treasury. 2:45 p.m. UK, we get a Bank of Canada rate decision. The global rates conversation has been one about rate hikes and hawkishness of late. Not so the Fed. We might get some hawkish commentary with the decision, but we are expecting a cut. Fed rate decision, that comes at 7 p.m. UK time, of course, followed by the press conference from Jerome Powell at 7:30 p.m. UK time.
Absolutely. People are talking about buying gilt, so that's got to be a tailwind for Rachel Reeves going into that session a little bit later on today. What else do you need to know this, what is it, Wednesday morning? Wednesday already. In a win for the French government, the country's National Assembly has adopted a social security bill for next year. This is a welfare package. In the second reading in the lower house, 247 lawmakers voted for the legislation, which, remember, suspends President Macron's pension reform. 234 voted against. The win increases the chances that lawmakers in France will now pass a new budget by year end. Phew. The German Chancellor, Friedrich Merz, says he believes that the rules-based alliance of normative values, once binding the US and Europe, has now come to an end. Merz says the new US national security strategy published last week amounted to the beginning of a US strategic realignment. He described elements of Washington's new strategy as unacceptable to Europe and advised President Donald Trump to avoid going it alone. And Australia's ban on social media for under-16s takes effect today, with platforms facing hefty fines if they fail to block young users. TikTok, Instagram, Snapchat, YouTube and Reddit say they will comply despite voicing opposition to the rules. Policymakers in countries including Indonesia, Denmark and Brazil are weighing similar measures. As a parent of teenagers, I have many views on this subject.
Yes, we are representing that group, particularly around this desk. We should acknowledge that right from the outset. I mean, is it going to work is the first question, because a lot of people in Australia are talking about how teenagers are trying to persuade each other to meet in slightly more off-grid locations, and, what will that mean? But just as you said there, whether this spurs copycat activity in other geographies, that'll be the big thing, because Australia is one thing, but if this spreads to other areas, does this become something of a cigarette moment for the industry? That's how it's being discussed by some opinion writers. Maybe.
All I will say is that my children are epically good at getting around parental controls, which
I'm sure bodes well for their futures.
Which I seem to me to be watertight, but seem incredibly easy for them to get around.
The truth right there. Coming up on the programme, the HSBC CEO tells Bloomberg some executives weren't fully accountable for the performance of their businesses before his restructuring. He spent 15 months doing that restructuring. He's been talking to Francine Lacqua about it. We'll bring you more from that conversation. Plus, interested in getting from Canary Wharf to Heathrow in 12 minutes? The chairman of Vertical Aerospace will join us with his vision of how he thinks he can make that happen. Up next, it's all about the Fed today. Markets are cautious while also looking at the future of the central bank's leadership, of course. If you have questions, if you want to get involved in any of these conversations, IB plus BBTV Go is the function to use. This is Bloomberg. Welcome back. 16 minutes past 7 here in London. The futures picture for Europe looks a little weaker. I guess that makes sense given the fact that the US session yesterday lost quite a bit of ground after Europe closed up, so maybe there's just some catch-up to play there. But of interest, perhaps, is looking ahead. US futures are almost entirely flat this morning, and that might be because we have a Federal Reserve meeting to deal with. So the Federal Reserve officials are primed to deliver a third consecutive interest rate cut later today. Kevin Hassett, who is seen as the front-runner to replace Chair Jerome Powell, believes there's room for the central bank to cut more than 25 basis points.
Jay Powell has done the right thing, which is he's taken the far left people of the board and he's coalesced them around, it looks like, a rate cut, which is the right move right now. I might like a bigger one, but I think that that's what the Fed chair has to do. Don't forget, you're managing a committee. And so getting rates down right now, it's a good thing. There's a lot more room to go.
Managing a committee. Interesting line. Let's bring in Bloomberg's Valerie Titel, who's been watching all things Fed for us. Of course, not just this morning, but every morning. Good morning, Val.
Good morning, Anna. Yes, it all is going to be about Fed Chair Powell's ability to manage the committee, to bring together a consensus and avoid a huge string of dissents. We know that we're likely to see Stephen Myron dissent for a 50 basis point rate reduction. And then on the Hawkish side, we've had over 4 officials express disagreement with cutting rates at the decision today. So we could be up for around 5 dissents. That would be the most essentially in modern Fed history, and a lot that could contend with Chair Powell's hold over the committee. We know that his position is up in May, but if he is losing the power to control the committee, perhaps that says a lot about where we're headed for monetary policy next year. But the market is pricing in a decent chance we are going to get that Fed cut. We're over 90% priced in the front end. The other thing to watch here is just how clear of a message that we will get from Powell, given we still have this data backlog. Not only the fractured Fed, but the fact that we do have a lot of data next week that the Fed is still waiting on, which can be key to their January decision. We're still waiting on November non-farm payrolls and CPI. We also have October retail sales that's going to be released next week, which is a good guide for how consumption, how GDP is shaping up for the fourth quarter. We do resume a normal data schedule, thank God, at the beginning of January. So their end of January decision, they will be totally catched up on the data. Maybe we'll have to wait till the end of January to hear a big shift from the Fed, whether it's in a hawkish or dovish direction. But the market is bracing for a more hawkish tone today. Take a look at the front end pricing for the Fed in 2026. We're now pricing in just 50 basis points of rate reductions. That's down from pricing in nearly 80 basis points of rate reductions just a few weeks ago. So there has been a hawkish shift in the market. Guy, I think this has a lot to do with the fact that previously, Chair Powell has characterized the last 2 cuts as a risk management exercise. I think the market is worried that today he could say that risk management exercise is over and they're prepared to slow down their pace of rate reductions. Absolutely, and that's going to be interesting to see how the market deals with that. Valerie, thank you very much indeed. Let's carry on the conversation and talk more about what this all means for markets. Florian Irielpo, macro head over at Lombard Odier Investment Managers, joins us now. Florian, what do you expect?
Well, first, I'm expecting the last macro pit stop of the year, and that will be a relief after such a heavy and intensive year for markets. Now, the key message for us is the cut matters much less than the message that will come with that meeting and that press conference. Meaning, as you've been mentioning it, the cut is widely expected. Risk management is probably not the right way to coin this series of 3 cuts. It's a rapid adjustment, and now we need a pause. And I think it's probably the outcome of this meeting. Now, what I will be very, very attentive to is essentially 2 things. The first thing is the revision of the dot plots for 2026. At the moment, we have 1 cut basically for the year ahead. The market is expecting 2 cuts after a strong revision. That's the first element we need to look at. That's where you will be able to gauge which of inflation and employment matters the most overall to the Fed. And then we'll have the avalanche of questions during the Q&A session regarding the forward guidance of the Fed. Will the Fed be able to put forward some guidance for us given the lack of data and the dissenting committee?
I've got lots of questions about what you just said. I want to start right back at the beginning. Why do you think this is the last macro pit stop? Are you not worried that other central banks have an impact here? It feels increasingly like other central banks do. The BOJ could be one of them. Other central banks are turning more hawkish. Why do you think the Fed is the last most important factor that we need to watch out for this year?
I think the simple answer is just look at world curves in terms of interest rates. Over the past, 10 days, what we've seen is a revision of this Fed monetary policy path by 25 basis points, okay? Especially for the long end of it. It's not the short end of it that has been revised, but the long end of it. That 25 basis points have been pushing up global yields across the planet by about 20 bips. You can take the Japanese curve, you can take the European curve, you take the US curve. The movement is globally the same. Let's not forget how systemic the Fed is. The Fed makes globally, has been making globally the fluctuation of the long end of the curve over the past 6 months or so already, and of course over a much long historical period than that. So the Fed is centric, much more centric than any other central banks. The Fed means the world, and it's an important thing to remember when we prepare our portfolio ahead of next year.
Okay, so that's why you're focused particularly on today, of course, Florian. Good morning to you. What does it mean if the Fed is going to be in a different place from the other central banks, big central banks globally next year? I mean, maybe your position is more nuanced, but some are expecting to see cuts from the Fed, whereas many other central banks might either be on hold or possibly even hiking towards the end of the year.
Yeah. It's a fair point. Our position for next year is a Fed that holds rates for at least the first part of the year, the first half of the year, and then comes up again with a series of cuts to further adjust its influence over the U.S. economy, because we need this first half of the year to be able to observe what's the impact of monetary policy on the U.S. economy, because there is still this lingering situation whether as to have we reached now is 3.25%, 3.5% a neutral rate for the U.S. economy? If that's the case, then probably that we should see the Fed monetary policy having a lower influence now on the U.S. economy. So we need an observation period, and after that, another series of cuts depending on the outcome of that. That's the first step for us next year.
Yes. But we get a new Fed chair in the first half of next year, Florian, and there would seem to be some political pressure, make of that what you will, to cut rates. You don't think that results in lower rates in the first half?
I think that there is, if you want to change the way the Fed operates, you need to change the governance of the Fed. So as long as we'll have 12 members voting, and you need to find a consensus, speaking from Switzerland, you need to find a consensus, well, basically that should probably act against the fact that there is somebody at the head deciding for the rest of the committee members. It's not something we believe in. Now, to be able to forcefully cutting rates, we need fresh data. It's one of the challenges of this meeting, right? The projections will have to be revised based on what? We have limited evidence due to the shutdown. Yeah. The only thing we have is ADP, ISM's manufacturing, and ISM services, if we fair about the data we got. So this is not enough to be able to trigger an avalanche, at least, of rate cuts.
Florian, what do you think will be better for risk assets? An improving economic outlook in the first half of next year for the US economy, or rate cuts for the US economy? Because it feels like you can't have both, but maybe you can.
Yeah. If I have to decide between the two, let's just remember that when the Fed cuts less rates than expected, which is the scenario, one of the two scenarios you were describing, it simply means that the U.S. economy is doing well. And when the U.S. economy is doing well, profits are more than decent. And then the cycle goes on, and cyclical assets are able to profit from that. Now, the issue I'm having is, what do you make of the U.S. dollar in such a situation? Because a lot of our hypotheses for next year are actually pretty reliant on the trajectory of the US dollar. So if we get a few cuts, like I was describing, then there is room for the US dollar to weaken, and there is room for emerging equities, emerging credits, European equities to prosper jointly with the US equities. If the Fed remains on hold for the full year, the situation would be very different.
Florian, thank you so much. Thank you for joining us. Florian Nielpo, macro head at Lombard Odier Investment Managers. We hope you have a good Fed rate decision. Coming up on the programme, we'll talk about the auto sector, the EV sector specifically. Lucid looks to make more inroads in Europe. The interim CEO of the US electric vehicle company joins us on set here in London next. This is Bloomberg.
Minutes from the opening trade here in Europe, opening trade for European equities. This is what futures look like right now. A little softer. In the States, they're actually sort of absolutely flat at the moment, but here we're a little softer. A little bit maybe to price in back end of yesterday's session. It's going to be interesting to see how the banks trade today. Watch out for what happens with some of the mining stocks. Silver's north of 60. There's a few kind of trades that you want to be watching out for there. So there's some interesting single stock kind of sector narratives that are going to be feeding in. But today really is about what happens with the Federal Reserve a little bit later on, which takes us on to, of course, what is happening with the bond market. This is the picture in Europe this morning. We're starting to open up. And as you can see, Germany, France and Italy all on offer this morning. Are we going to see higher yields? I'm fascinated to see where we go with the US 10-year. We're just shy of 420 at the moment. If you get a hawkish Fed today, do we get through 420? Where does that key line in the sand take us next?
Let's pivot from the macro conversation, of course, plenty more on the Fed as we go through the programme, to what's going on in the EV car sector. California-based electric vehicle maker Lucid is setting its sights on European expansion. But the sector is facing heightened competition and uneven demand for EVs in the region. Earlier this week, Lucid's stock was downgraded by Morgan Stanley, which cited an EV winter in 2026. With us on set, the interim CEO of Lucid Group, I'm pleased to say, is Mark Winterhoff. Very nice to have you with us.
Thanks for having me.
Thank you for joining us, Mark. So can I ask you about this idea of an EV winter? I mean, over in the United States, the sector having to survive without the EV tax credits. Here in Europe, policies are in flux, it would appear. Do you recognise that characterisation?
Well, I mean, there's certainly a slowdown in demand right now on both sides of the Atlantic. I mean, in the US, as you said, you know, the discontinuation of the tax credits, they caused like a pull forward of certain purchases or leases, and now there's a little bit of a slowdown. We are in a good situation that we are just ramping up our second vehicle, the Lucid Gravity, our first SUV, which basically in the US has a very big demand. So we are still working through our backlog. So we are a little bit insulated, but definitely there is a slowdown. There's no question about it.
And sorry, carry on.
When it comes to Europe, well, we're just getting started. Yeah? So the vehicles actually are on the boat right now. The first that we have produced here that have been ordered, they arrive later in the year, and then they will be starting to deliver in the first quarter of the next year.
So that's when things get real in Europe for the business.
Correct, right.
And what is the competition like in Europe right now? Who do you see bringing the toughest competition? What's the challenge?
Yeah, I mean, you're probably alluding to the Chinese coming to Europe and to other markets, but I think in our segment right now, we are playing in the premium and luxury segment right now. Our competition is more, you know, the traditional automotive OEMs, the Mercedes and others of the BMWs and the like. So we don't see right now Chinese being a big threat for us. Obviously, with the Lucid Air, our luxury sedan, and then the Lucid Gravity, that is only our start. Yeah? We want to bring a lower-priced vehicle, or actually a platform with several vehicles later, and then we will also go down in price. But we still want to stay in the premium sector. So we see the traditional OEMs and obviously other American OEMs more our competition.
How many cars are you producing, vehicles are you producing at the moment? Are you going to make 18,000 this year?
Well, I cannot say that this right now, so we have to wait until we show the earnings at the end of the year. We are on a good track right now. So we earlier in the year we guided between 18 and 20, and then recently we lowered a little bit because of some supply chain moves that we had. So yeah, well, I mean, we're doing everything we can in order to get there.
And in terms of what is going to hold you back, you talked about the supply chain issues. Yeah. It seems as if the world is becoming more fragmented, not less fragmented. Magnets are hard to come by, key input into your business. Aluminium's hard to come by, key input into your business. Yeah. Metals are getting more expensive. I got silver at 60 this morning. Yeah. There's lots of kind of inputs. Is it getting more expensive to make cars?
Yeah, it definitely does. Definitely does. And it's also, I mean, on top of the things that are maybe driven by, you know, more macro and political things. Yep. When you talked about aluminum, the U.S. industry was also hit by a fire, actually, by one of the big suppliers, right, which you had to navigate around. So it definitely is. I mean, that's where we have a little bit of a benefit right now, because we have two production sites. We have one in the United States. Right now, all of our vehicles are being built in the United States. But coming end of next year, our next platform will also be built in Saudi Arabia, which we agreed with the Saudi Arabian government and also with our backers there already long time ago. So we have different ways of, navigating this.
The Gulf is ferocious competition. Every time I go to the Gulf, I see more and more Chinese vehicles. And I know you say you don't compete directly with them. Yeah. But the Chinese are getting bigger and better and going up market, and the product they're offering is getting more and more competitive. Yeah. The Gulf looks like a tough place to be right now.
Well, actually, it's our second largest market right now. So we have actually quite good demand down there. And also, I think that's where our focus on EVs really helps us, because we are seen as the technology leader in EV technology in the industry right now. And that's what I think differentiates us from many others. And when it comes to the Chinese, I totally agree with you. I've been in Shanghai not so long ago, and it is impressive. But at the same time, that's why I think the current slowdown, geopolitical slowdown, let's trade a little bit lightly with EVs is a big mistake. Because when you take the foot off the pedal, you will only fall further behind. So that's why we don't take the foot off the pedal. We really double down, and we want to be amongst the leaders going forward.
And so you'll need time then to ramp up the production, as you've been talking about. So what does the cash situation look like in the meantime? I was reading some Bloomberg intelligence research that said you could burn through $3 billion of cash in 2025 and 2026. It's a competitive market, and the gross margin that you report doesn't look as favourable as others in the sector. So how do you make progress on that?
Yeah, honestly, we're not in a money-making situation right now. We're still ramping up, right? And some people don't really understand how automotive works, right? You make a lot of investments in the beginning. We're talking about billions, and then you increase the volume, and then you get the money back.
Sounds like Tesla.
They did that as well, exactly, yeah. And so we are still in the phase where we make investments. And, as I just mentioned, end of next year, that's when our second plant will come online. So right now we're making investments in that plant, but also continue to make investments in our plant in the US. So we have a clear trajectory. We have also additional term loans that we got from our backers, PIF. So we are funded until well into 2027. And, when it's opportune, we will go back to the market if we need it. But we have a clear trajectory when we want to become profitable.
And thinking about Tesla, do you have real solid market intelligence that you're gaining customers who previously drove Teslas, but maybe they're not so excited about the political activities of some of the leadership and so are looking for other options? Right. Do you have real market intelligence that shows that?
Absolutely, we have that. And it's actually twofold with Tesla. It's not only because of, are you for or, from which political side you're on. It's also, people want to have choices. And I think let's say for many years, Tesla owners, the car doesn't change a lot. Granted, when it comes to autonomous driving, FSD and so on, it develops, but the car doesn't really change a lot. So they want to have options. And many people tell us, hey, with what we're offering now, it's now finally an option that they want to move away from Tesla.
How should Lucid be valued? Because Tesla is valued as a robotaxi company, as a AI company, as a technology company. Yeah. In some ways, the car doesn't really matter. It's the technology that the car can deliver that matters the most in terms of the valuation. Yeah. It's about like an F-16. We've been flying F-16s for years and years and years, but we keep upgrading the package and therefore the aircraft gets better and better. That looks like it's the way that the auto industry is going to be going as well. How do you get... should you be valued as a car company? Or should you be valued as a tech company? How do you transition from one to the other?
Yeah, we actually call ourselves also a technology company. Okay. We started with the EV technology. That's what we focused on, and that's why we are a perceived market leader in that space. Most advanced EV technology. But we are now expanding into other areas. This year we have done partnerships with Uber and Nuro to also provide robotaxis, which are enabled by our vehicle technology. We're using right now Neuro's driver technology, the AV technology, in order to create the robotaxis. But we are doing all the integration, make sure it actually works and works safely later on. And that's a starting point. We also recently announced a partnership with NVIDIA for B2C vehicles, that you and me drive, also to get to high levels of autonomy, because we think that is very important. And we have other ways internally and also with our cooperation, again, with our partners in Saudi Arabia, where a lot of investments right now around AI is happening, to see what is for us the next steps. But that's very clear, something that I have changed in the beginning of the year, to focus not only on EV technology, which was our starting point and really created a great foundation, to now expanding into AV and other topics.
If anybody wants to see a galaxy, there's one parked downstairs, right?
Gravity.
Gravity. It wasn't a galaxy. Gravity.
Down.
You're thinking about our next subject. That's why. We're on to talk about space.
So there's one parked downstairs. So if anybody's in London and wants to see one of these things,
exactly,
there's one parked outside the building. Mark, nice to see you. Mark Winterhoff, the interim CEO of Lucid Group. Turning to galaxies, which actually was where my mind was going, we have learnt that SpaceX is moving ahead with plans for an IPO next year, potentially the biggest in history. Sources say SpaceX is targeting a valuation for around $1.5 trillion. Let's bring in our deals reporter, Manuel Bagori. Manuel, how significant would this IPO be? We've been waiting for it for a long time. Talk us through the implications.
Guy, it's been touted for a while, as you well said. it would be remarkable. It would be historical, record IPO potentially happening as soon as next year. So here are the animal spirits of deal making back on track. The momentum is building up from this second half of 2025 and potentially accelerating into next year. We're seeing the activity really ramping up both on the ECM front and on the M&A arena, as well, with some really large transformational deals taking place. And here it is, SpaceX potentially raising north of $30 billion in what could be the largest ever initial public offering. So remarkable, as you said, Guy, valuation potentially reaching $1.5 trillion, which is really unheard of. And obviously a lot of questions around the different business units within the group, and also what may happen next with some of these, whether the likes of Starlink or others could be spun off over time, creating even more liquidity and even creating more value for the whole group. So definitely one to watch. It's going to be a busy 2026 for sure.
And Manuel, how does this play into expectations for the US IPO market next year? This is going to be enormous, but it's not just a one-off. There seems to be growing expectations that we'll get more IPOs stateside.
Exactly, Anna, and it's been a number of years, right, since Saudi Aramco did the mega IPO back in 2019. That's so far the biggest, and this with SpaceX could potentially torpedo that in a way and be even larger than that. Obviously, the expectations are high into 2026. ECM in the US has been a little bit more muted, even though there is being a good number of deals and the volume has been also picking up. Even here in Asia, right, we've seen a significant amount of activity with Hong Kong in particular, and also the markets like India really keeping up a good pace of deal activity on the ECM front. But other markets, including Europe or London in particular, have been a lot more subdued. And now, obviously, the world biggest market for deals, both M&A and IPOs in the US, could get a significant boost with a deal of this caliber.
Manuel, thank you. Thanks so much. Our Bloomberg deals reporter, Manuel Bagori. Could be a busy year for Manuel and others in the deals and IPO space. Coming up on the programme, Anglo-American holders say yes to the planned merger with Tech. More details on that M&A story and other stocks in focus for us. This is Bloomberg. Welcome back. This is the opening trade. 13 minutes until the start of equity trading, cash equity trading, and European equity markets look as if they'll catch down with what we saw from the United States yesterday, and in particular the FTSE 100 under a little bit of pressure this morning. So we'll watch for that at the open. Something that is, of course, a presence in the London market. HSBC, the CEO, Georges Elhedery, says not enough executives were fully accountable for the performance of their businesses before he began his radical restructuring of the bank 15 months ago. Speaking on the upcoming Leaders with Francine Lacroix podcast series, Elhedery said people needed to be patient when it comes to structural changes.
We moved from more than 20 people to about 12. More importantly, we moved from 0% single accountability. Everything had dual or multiple accountability to now about 60% of our revenue is generated under single accountability. So that's important. And then the last thing, Francine, is to be patient. Because we're not solving simplification overnight. It's going to be a journey, and we have to be relentless at that journey, quarter after quarter, month after month, until we get the desired outcomes. And that journey is still on, we're not there yet.
HSBC CEO Georges Elhedery speaking exclusively on the new Leaders with Francine Lacroix podcast series, which launches early next year. I mean, do we assume that he did not enjoy his co-head of global banking and markets role very much? Didn't enjoy sharing it. He wants to get rid of all the co-heads, and he's successfully done that, it would seem.
Accountability. I need somebody to focus on when figuring out exactly what business is performing, what business is not performing. That seems reasonably logical to a certain extent. I think the bigger picture in banking, though, is the one that comes out of JPMorgan today or yesterday, and the fact that costs are rising.
Yes.
This is going to be the challenge that banks face. Costs are rising in so many different aspects of their business, particularly as they transition to new technology.
Yeah.
How much of that's going to be a factor that Elhedery has to think about, and all these other banks.
And there's so much expectation that sectors will be able to employ AI. But if your systems are critical, but also old in some cases, and difficult to connect to each other, and the price of failure is so huge, this could be difficult.
And expensive.
Yes.
And that's going to be interesting to see, because European banks have been the driver of the stock market performance story here in Europe. The Fed. Let's get back to the Fed. The Fed is, to be honest, the only story, really, that we need to focus on today. So Skyler's here, Skyler Montgomery-Koenig from our MLIV team, to talk once again about the Fed. Weirdly, though, the story has evolved. And from this time to yesterday, JOLTS is better. The labour market doesn't look quite so challenging. Is there more of a case today than there was yesterday for this hawkish cut that potentially the market is now looking for?
Yeah, I mean, I think on the aggregate, the data's already, it's been pretty good for a while now.
Yeah.
Yes, JOLTS was a signal yesterday, but I think actually we got more of a shift earlier in the week, as in we are getting kind of hawkish pre-positioning this week as we start to think about hikes next year. And I think what's super
hikes in the Fed?
Well, I mean, I think hikes elsewhere, but I'm certainly thinking about the possibility of hikes from the Fed next year.
Okay.
But I think what's interesting is, as you've seen markets think about these hikes, and a lot of that's been centered around Europe, with Schnabel comments being more hawkish, the dollar's actually gained. And I think that tells you what's going wrong in terms of current pricing, because it says, yes, you're thinking about ECB hikes, but European growth is meant to be lower next year than this year. Inflation's around 2%. There are downside risks there. Whereas in the U.S., you're thinking about 3 to 4 cuts next year in a global environment where you could have hikes elsewhere. And you have inflation closer to 3%. And so I think certainly while we've had pre-positioning for hawkishness, more of those cuts can come out if we have more commentary skew that way later today.
Are you bracing at all for any kind of overheating then of the US economy next year, Skyler?
Yeah, absolutely. That's something I'm worried about. I think we already have pretty strong growth. And it's interesting when you look at the Fed projections for the economy, I don't think they'll get a lot of attention because they're unlikely to change. But we have a 1.8% growth projection for 2026 from the September meeting. That's the same thing they were forecasting in the first quarter of this year. And I think the idea is there's so many policy changes that have happened. Yeah. There's uncertainty about what that actually means for the economy. And so you kind of just forecast something closer to trend and watch how the data comes in. But you know the economy is resilient. You're getting fiscal into next year. You're having monetary ease. Financial conditions aren't particularly tight. So I think as you have inflation at 3% and you have inflation that's both supply and demand driven, meaning that tariffs can feed more persistently in, you need to worry about it.
Okay. Can I just come back to the ECB? Got Villeroy out this morning, Bank of France. Bank of France will raise its growth forecasts. talking about better growth. The Germans, at some point, and we're starting to get the details of it, are going to spend some money. Are we underestimating growth in Europe next year?
I mean, we've had downgrades already in that growth outlook for 2026, but it's not been huge, and I'm actually skewed more that way because I think there's this broad expectation. I think currently market pricing, if you look at Eurodollar versus growth forecast, it's not caught down, but we had this expectation you'd get broad stimulus in Europe. You haven't really gotten it anywhere other than your Germany core, and the German stimulus is being redirected to kind of everyday data operations. Around 50% of it is. So I think we're actually still over-optimistic what that growth boost will be in Europe.
Okay, Skylar, thank you very much. Skylar Montgomery-Koning from Bloomberg Markets Live. You can get more details. MLIV Go is the function to use on the Bloomberg terminal if you want to find out the thoughts of the Markets Live team. Let's get our stocks to watch. Chloe Melly's here. Chloe.
Good morning, Anna. Let's start with mining today. So Anglo American and Teck shareholders have approved the combination of those two companies, which will create a $50 billion metals producer. So let's see how the shares react today. It's a big milestone, but of course there still needs to be some regulatory approvals. Analysts are saying that at least in Canada, that is pretty much a done deal, and that approval has a really clear path ahead. Moving on to the French stocks, which may get a bit of a boost, a bit of a relief this morning after the National Assembly approved a welfare bill. So that means that we are likely to see a budget being passed by the end of this year. So this is quite positive, and that political stability could feed into positive movements across those different sectors in France this morning. And finally, Aegon, the Dutch insurer, has announced a bunch of different things this morning. It's moving its head office and legal seat over to the US and rebranding as Transamerica. It's also unveiled a new targets, a new buyback, and a strategic review for the UK unit. So let's see how things change this morning for Aegon if investors are quite keen on those big changes for the company.
Okay, there's some single stocks that are worth focusing on as we work our way into this morning's open. Chloe Melly, thank you very much indeed. Keep an eye on the metals trade as well. Keep an eye on what's happening with the banking trade. What's the JPMorgan read across going to be in terms of the narrative that we're going to be watching out for this morning? At the moment, the futures are moderately negative, but it's Fed day and everything could change a little bit later on, but it'll be much later on. Here in Europe, we'll be thinking about it tomorrow morning. Day 3 of the Fed coming up. Anyway, the market's about to open. This is Bloomberg. Welcome back. A few minutes to go until the European equity session is upon us. Let's talk about what yesterday tells us about today. We went out at session highs yesterday on the S&P. The European close was at session highs. We rolled over after that into kind of growing speculation around what the Fed is going to do, and as a result of which Europe has to price in that this morning. So we are down a little bit. Eurostoxx 50 futures down by 0.2%. FTSE's down a little bit more, which is interesting. We're down by 0.4%. DAX futures are down around 0.1%. It's going to be interesting to see how the French market trades today. A bit more positive news coming through on the politics front. Did you listen to what the head of the French Central Bank said this morning on French radio? Talking about upgrading French growth forecasts for next year. How do you read that into French equities this morning? In terms of where we were yesterday, so Europe went out kind of here. That's basically the pricing that you've got to deal with first thing this morning. It's not a big story. And to be honest, the main action is going to come a little bit later on. Of course, we're waiting for the Federal Reserve decision. We're expecting a cut. What does Jay Powell say in the press conference can be really critical to where we are this time tomorrow, Anna?
Let's have a look at some of the individual names and perhaps more broadly sectors in focus this morning then, Guy. And we'll start with Anglo American. We do actually have some news flow from this one. So Anglo American and Teck Resources. Shareholders voted in favour of the two companies combining. So we've got a go-ahead for that particular M&A. M&A increasingly a theme, it seems, as we go through this year and maybe then into next. We are also watching the banking sector. The banking sector really in focus after we heard from one of the senior executives at JPMorgan. That sent the share price of JPMorgan down 4% in session yesterday, and it was all about concerns around the costs there. We'll also watch the mining sector. We've got silver prices looking resilient, but other metals prices looking a little softer. What does that do to London, Guy?
Okay, well, let's find out. Let's get to the market open. It's Fed day in the USA. What does it mean for European markets? Well, at the moment, not very much. We await to hear what Jay Powell has to say a little bit later on. It's going to be a holding action today. The FTSE 100, therefore, is fairly flat. The Stock 600 is fairly flat, but we're waiting for other markets to open before we get a clean read of what is happening there. I'm interested to see what the CAC 40 does today. Does politics influence that market this morning? What's happening over in Germany is going to be quite interesting as well today. Remember, we've still got other rate decisions still to come this year. The Bank of England, the SMI, BOJ is going to be one to watch out for as well. Other central banks started to sound more hawkish, and that's a message you're certainly hearing this morning from the ECB. Shimkus is out, Vilroy is out, sounding, I would argue, just a little bit more hawkish at the margin. The ECB's done. Therefore, you could assume that the next move is a rate hike. Does that come next year? And what impact will that have on stocks? Anyway, so that's the picture as I tap dance towards the CAC Open, which is not really playing ball this morning, down by 0.2%. The IBEX is down by 0.2% here. Feels like we're in holding action, Anna, waiting for the Fed a little bit later.
As we wait, it would be great to see Guy Johnson tap dance, though. So if you'd like to see that, IB plus BBTV Go is the function to use on the Bloomberg terminal. European equity markets then, Guy, opening not quite as sluggishly as maybe we'd feared. Futures were suggesting something a little worse for the European equity markets. But we actually have, well, we're negative, so let's not lie about that. We're negative, but maybe not by as much as expected. In terms of the sectors, though, we are 3/4 of sectors in the red and only a few to the upside. Energy is the best performing sector. We're actually pretty flat on the oil price right now, but we see Siemens Energy, Vestas, this is a bit of a theme, isn't it? This is the wind story, perhaps, living another day. We were talking about that a lot in yesterday's session. Basic resources, yes, the silver price has outweighed concerns about other metal prices, and Fresnillo is the best performer in that sector, and we see that the mining sector as a whole is pretty resilient this morning.
So what I find interesting today is that the banks are up, not down. So JPMorgan got hit yesterday. Other banks in Europe are not doing a similar thing. So HSBC, third biggest weight to the upside when it comes to the Stock 600 this morning. Right behind it, UBS is trading higher. You've got some of the other European banks as well picking up the pace a little bit on the upside. So that story of higher costs at JPMorgan, in some ways you can argue would be negative for the rest of the sector. If JPMorgan's got a cost problem, what do you think the rest of the industry's got? That doesn't seem to be reflected in some of the European names. Miners are, though, having a better day. So you've got Rio up, you've got Glencore tracking a little bit higher as well, which is interesting.
Yes, it's always a good day to mention fast cars, so let's talk about Ferrari. And this is one of the biggest weights to the downside. Race IM in the auto sector under some pressure today, cut to neutral at Odo. So there's a broker action, analyst activity to think about. And this follows Monday, where we saw it downgraded at Morgan Stanley. The plan to limit volumes clearly going down negatively there. So we'll keep an eye on that one.
They had an OK Abu Dhabi Grand Prix, though. Anyway, let's park that one for the moment. Helen Jewell, International CIO of Fundamental Equities at BlackRock, joining us around the table. How important is today's Fed decision to what happens next in 2026 for global equities?
Yeah, great to be here, Guy. I mean, of course, it's always important, and there is an expectation of a cut. But I think what we all expect is that the narrative around the cut is actually going to be the more important thing. The expectation is going to be more of a hawkish cut. And we had, of course, originally priced in quite a few cuts kind of through to the end of the year and into next year. Now, if that starts to stabilise a little bit, then, of course, from an equities perspective, this incredible rise in equities we've seen this year might see a little bit of a pause. But as long as the narrative is not too much of a hawkish narrative, as long as there is a feeling of, OK, we have this in control, we're just managing it sensibly, I don't think it's going to be anything too much to worry about.
I was talking to Scarlett about this a few minutes ago. She's talking about overheating. There's the risk of overheating that the Fed might actually have to hike in 2026. But if it comes, which one do I deal with first? Do I deal with the fact that actually growth could be better? Or do I deal with the fact that the Fed might have to hike as a result of it? Which one of those two narratives is more important?
I think the narrative of growth being stable and in good shape is the most important one for the markets at the moment. I think there's an expectation that there won't be anything which is overheating. If there is an overheating, that would not be good for markets. But a relative feeling of stability is the most important thing. And that, I think, is what we're also seeing in Europe this morning. You mentioned earlier on, Guy, about the European banks. I think the reason the European banks are up, actually, is that there is a narrative coming out that there is stability. Stability drives loan growth. Loan growth is what is driving those banks' prices this morning. So the narrative of stability is the single most important.
Are rate hikes good for European banks? Just sorry to jump in.
Not. I mean, rate hikes are always OK for banks, but they're not what is driving banks' prices at the moment. Okay. The thing that is driving banks' earnings, we're in a kind of sweet spot for rates. When you're in the level we're at now, a quarter bit, it's neither here nor there. The thing that really drives is the loan growth, and that is what's important. So it wouldn't be bad, of course, but I think actually from an overall perspective, where we're sailing at the moment is the sweet spot for banks.
OK, Helen, good morning. Let's think about 2026 then, and Europe, and what to get excited about in Europe. I mean, banks is an obvious area of focus. It's done well. The sector has done well. I think it's best performing, isn't it, year to date here in Europe. But you point out that quality stocks in Europe had their worst year ever.
Yeah.
Remind us what that includes and why this has been such an area of underperformance in 2025, and whether that changes next year.
Yeah, no, it's a great point, Anna. So the quality stocks are those stocks, high returns companies, very resilient earnings, so high cash conversion. And the reason they've had a bad year in Europe this year is probably two reasons. The first reason is, on the whole in Europe, they are the exporting companies. And the exporting companies have been hit because the dollar has been weakened, and they've also been hit because you've got tariffs and tariff uncertainty. I mean, what a year it has been. It's incredible when we think about all the things that we've been through. So those two things combined have made it very difficult for those quality growth names in Europe. The second reason, as well, we should also put in there is that the valuations have, on the whole, been, over a period of time, just got higher and higher and higher. They always trade at a premium multiple to the market, but maybe that premium multiple had got a little bit stretched, and therefore they've come down a notch. So the two things of the type of companies they are, exporter companies, and the premium we were paying, means they've had a little bit of a reset in 2025.
Okay.
But I think it's time for them in 26. Maybe we've got stability in the dollar again. Maybe what we've seen is that worse in terms of the tariff news being over. The valuations look more interesting. So maybe it's time for those names to go again.
So that makes me think about China and the prospects there and the prospects to export to China. I mean, we've had the US administration calling on China to diversify their economy, to improve consumption in their economy so they're not so export driven. We've heard the IMF just this morning making that same point, saying, you know, China needs to do something to stimulate the domestic demand story. Does any of that stick, do you think, Helen? Is that something that those European quality names can count on?
Yeah, no, I think there is understanding kind of where the export sensitivities really are. But then also this point of there's two factors, how much you are able to export and the demand for exports in that particular region. So when it comes to China, I think what we probably underestimated is the level of demand that there were for some of the goods within Europe. So even if there are some kind of controls on the level of exports, if the demand for those exports, because the China consumer is very solid, remains high, then actually those two things can in some ways net off against each other. So I'm not saying we're not concerned about that. I think already you've again seen it this morning. I saw on that list of stocks that are up and down, a lot of those are being influenced because they are exporting companies. And understanding where the exports are going and what is driving those exports is, I think, obviously I've been sat here as I've been seeing it come up, is probably what is driving those moves under the hood.
You've mentioned stability a few times.
A few.
How convinced are you that 2026 is a year of stability? It feels like the exact opposite to me. There's so many imponderables. I don't know what the Fed's going to do. I don't know whether the rate hike cycle is going to be coming through. I don't know if we're going to get a peace deal in Europe. I don't know what defence stocks are going to do off the back. The list goes on and on and on. There seem to be so many imponderables in 2026. Stability?
So for me, when I talk about stability, the single most important thing is the stability of the consumer and how the consumer is behaving.
Right.
And actually those things and those variables, you know, again, if you think about the everyday consumer in the US, we're seeing some weakness on the lower side, but a Fed cut with some feeling of, OK, actually there is some kind of growth coming through in the market, not overheating, but a market and a jobs market by that. Yeah. That is actually really good for a consumer perspective. So when I see stability, I'm talking about stability in the consumer in Europe. You know, again, you don't go out there and feel like this is a country or a continent that is nervous in terms of consumption levels. And at the end of the day, Guy, that is what really drives the returns that we're seeing in the market. Now, do I think it's going to be a straight line? Absolutely not. But let's not forget this year. It was January, we had that enormous pullback DeepSeek day. Then we had Liberation Day. Then we had big degrossings in August. And yet we're still sitting here at the end or mid-December with so many major indices up double digits. So is it stability? Yes, but at the same time, it might be a bit volatile.
Double digits next year?
I don't think so. I think it's almost... is it odd to say? Don't really want that. This is the third
is that overheating? Would that be overheating?
That's unstable. Yeah.
And that's the point at which the multiple starts to go in excess of the earnings. And actually, we don't want that. It's been such a good year that those pockets of really interesting value that I talked about at the start of the year, things like European banks, European defence, they're still there, but they're not nearly as compelling. So actually, do you know what? dare I say it, it might be nice to go for a 6, 7, 8% year next year.
Sounds a little sleepier, but, maybe we take that. That's fine. But fundamentals, the big point then is that fundamentals return in a big way. If we get this stability, which is a big if, then there's room for fundamentals to sort of reassert themselves.
It really will be back about the fundamentals. And the AI story, and it's amazing in some ways that we've got this far without talking about that. It's all about where that goes as well. And I know we've talked about this a lot, and this obviously happened yesterday as well. That is where the energy names are starting to respond. And by the energy, we mean the breadth of energy, the clean energy, the traditional energy, the energy efficiency names, the networks as well, a number of which, and the utility companies, which also have had a very, very good year. So that second leg, and that's expanding, and that diversification from that core group of AI names is also key.
Yeah, and so where is the AI focus in Europe next year then, if that's what we're looking at? Is it still around energy?
It really is. I'd love to say we have hyperscalers. I'd love to say we have some, other names in that part of the AI story, but really it is about the energy. But where energy comes from, where energy is efficient, and how energy gets from A to B. That's what it's going to be about.
Helen, great to see you. Enjoy the holidays. Thank you very much indeed.
Great to be here. Have a great Christmas and New Year going.
We will see you in 2026. Helen Jewell, Fundamental Equities International CIO, joining us from BlackRock. Call 6 looks like there's some of the names that Helen's just been mentioning. Maybe a focus on this board this morning. Some of the defence stocks, which have had such a good year, maybe just a little bit of a move off from what we saw yesterday. Some of the luxury names are a little softer as well. But there's that tech trade. ASML front and centre alongside Schneider, which provides all the kits and everything else that goes into the AI centres, doing well. Let's focus where else we are watching this morning. I see insurance companies are catching close eye.
Yeah, absolutely. Good morning, Guy. Aegon is down massively this morning. We're down 7% after it announced quite a lot of changes, actually. So it's moving its head office and legal seat over to the US as an attempt to kind of refocus on that market. It will also rebrand itself as Transamerica, and it also announced a strategic review of its UK unit. So there's a lot to digest, and it seems that investors are maybe not too happy about this, and therefore we are down quite significantly for that insurance company this morning. Moving on to Delivery Hero, which is up this morning after saying it was considering the next strategic step. So investors have been pushing for a divestment, a sale of maybe parts or the entirety of the company to really boost efficiency, boost profitability. And it seems that Delivery Hero is listening to them. No decisions have been made yet, but investors are quite happy that that company is thinking about those strategic steps. Moving on to Siemens Energy, which is up this morning as well. There's a couple of things happening there. First of all, we have got an activist investor pushing for a potential spin-off of the wind unit, and there's also really positive read across from GE Vernova over in the US, which doubled its dividend, boosted its forecast, and so that spells actually really good news for that electrification sector, and that is translating over to Siemens Energy this morning with shares up 3.7%. And finally, Ferrari is down almost 2% after being downgraded by Odo this morning. This follows a downgrade by Morgan Stanley earlier this week. It seems that the focus on maybe refocus on restraining volume to boost exclusivity is not being taken that well by investors and analysts, and therefore we are down for that company this morning.
Ferrari then on the back foot, not in the fast lane. Chloe, thank you very much. Chloe Nelly from our equities team with those movers. Coming up on the programme, JPMorgan shares fell after the US bank posted higher than expected, or flagged that it is experiencing higher than expected costs for next year. We'll have more on that story next. This is Bloomberg.
Wednesday morning, Fed day. We've got a few hours. We should have a countdown clock. We should have a countdown clock to the Fed, because that's basically what we're waiting for today. European equities, look at that. Absolutely no movement. We are basically waiting to see what the Fed does a little bit later on. Below the surface, there's a few single stocks that are moving around that are really interesting. Aegon, I think that story is amazing. Maybe we'll come back to that a little bit later. But the unch tells you everything you need to know on that screen. In terms of the sectors, energy's outperforming. Media's not doing too badly. Basic resources on the mining story is up. Technology and banks. And banks takes me to our next story. which is that JPMorgan shares are under a little bit of pressure. This after the bank posted higher than expected costs for next year, or talks about higher than expected costs for next year. Tom Metcalf, who leads Bloomberg's EMEA finance coverage, joining us around the table to talk about this. This really caught my eye this morning, the fact that JPMorgan is out talking about the fact that its costs are going to be higher. And I just thought, if JPMorgan's costs are higher, that's bad news for everybody else. But just talk to us about the details of why and where the costs are coming from.
Yeah, so this is all coming off an event yesterday where Marianne Lake, who basically runs JPMorgan's retail bank, said we're expecting our expenses to go to about 105 billion. So it's about 9% higher than they were saying for 2025. So that's a big jump. And, there's two elements here. One, this is bad news for JPMorgan, just generally. No one likes to see expenses rise. Yep. But it's probably worse news for its rivals. So if you see JPMorgan down 5%, you wonder how this might second order affect the Bank of America's, the cities. Yep. Because, what Marianne Lake was saying is this is basically largely in her unit, so retail, community banking, and also that this is basically driven by volumes. So, while there will be higher costs, you'd also expect a sort of revenue improvement.
Yes, that's what my mind went to when I saw this. I thought, well, that's only half the story, isn't it? That's, the costs go higher, but it's driven by an expansion in the business. So what's the revenue number? But we only got half of it yesterday. But this has happened before, hasn't it, Tom? This cost guidance and then the business responding to it, well, weighing on the shares, then the business having to respond to it. What's the playbook?
Yeah, exactly. Very similar to 2022 when it was almost the same. Expenses kind of spooked the market. And look, shareholders are extremely sensitive to the bottom line. That's something the company can control. So, even if there is the positive revenue side of the story, it's understandable they react more to the kind of expense side. But yeah, what JPMorgan actually had to do in 2022 was, they realised perhaps the message hadn't quite landed the way they wanted. They held an investor day, reassured the markets, and obviously been on a pretty much tear ever since.
There is an argument that says, to Anna's point, this is the wrong reaction. Knocking the stock lower is the wrong reaction, because actually they're saying it's a revenue. We're spending more money because we're making more money, and you wonder therefore. And Mike Mayo, I think, was making this point that actually a move lower in the share price might be greeted quite quickly with people coming in and saying, actually, this could be quite good news.
Yeah, absolutely. Yeah, Mike Mayo saying, hey, look at the other banks, basically, because, that's the bigger worry. Because, JPMorgan, market leader, this presumably will help deepen its position. So it'll be interesting to see, and I think Mike Mayo was saying this, let's see how the other banks react to this. Are they going to send any messaging out as well?
Yeah, and what else did Blake have to say? I mean, I think she's on the consumer side of things, but did she have other clues as to how the business is performing more broadly?
Yeah, she kind of broadly spoke to 2026. So, being Bloomberg, we're fascinated by the high finance side. So two things she said, sort of investment banking fees, I think she was saying likely to be in the low single digits. So sort of slightly coming off today, this year's amazing performance. And then on the trade-in, which again, positive, you could argue, I think we were saying low teens on the trade-in side. And again, that's higher than what analysts were expecting or sort of predicting for 2026. So plenty of positives in this speech, but it's always interesting to see what the market jumps on. And right now, they're just going, look, bottom line, that's just bad news.
It was the costs. OK, thank you very much. Thanks to Tom. Thanks for the update. Tom Metcalf, Bloomberg's Tom Metcalf, of course, bringing us the latest on the banking sector. Now, Marianne Lake, who we were just talking about there, head of JPMorgan's consumer banking arm, has cited investing in artificial intelligence as one of the key cost drivers for the Wall Street giants. That links us nicely into a new survey by Bloomberg Intelligence, which reveals that C-suites in all industries are experiencing shortages in AI infrastructure, acting as roadblocks to AI adoption. Matt Bloxham from Bloomberg Intelligence worked on the report and is with us now. So let's start with that point. Good morning to you, Matt. So this idea that they're all sectors reporting a shortage of AI infrastructure, does that mean we shouldn't worry quite so much about the speed and pace of AI rollout and build-out?
Yeah, I think definitely in the short term, I see this was involving over 600 C-suite executives. And one of the questions you asked is, what are the biggest concerns you have about implementing your AI strategy? And definitely the availability of AI infrastructure was up there amongst the biggest concerns. I think the short term, that kind of matches what we hear from likes of Microsoft, that they can't bring enough capacity on quick enough to meet the demand they've got. I think over the medium term, that the picture's still quite clouded because higher up the rankings of concerns amongst the C-suite, in particular, is the issue around the cost of AI implementation, linking to that JPMorgan story, and also the return on investment they're going to get from it. So I think 2026 is a critical year for corporates in how they evaluate the AI pilots they've got underway and whether it makes sense to move those forward in 27 to much bigger programs. And that's critical for the likes of AI that have this $1 trillion plus investment plan. And if corporates don't see the big ROI, then maybe it's going to take longer for that demand to come through.
Does AI equal job cuts?
According to our survey, no, it doesn't. I think in the short term, 66% of respondents said they have been making tactical cuts to heads, but it's more of a resource allocation. When you look on a 3-year view, 62% said they plan to increase jobs as a result of AI, on average by around 4%. I think this kind of plays into this kind of theme that actually, technology and human capital need to go hand in hand, and there's like a big role for jobs in the near term.
There's a good story on the terminal on this morning. You were flagging it earlier.
Well, yes, and part of your report pulls this out, the fact that in the banking sector, in the financial services sector, jobs might go up before they come down.
Yeah, exactly. In the banking sector, it's about a 5% average expected increase on a 3-year view in jobs. Over about 2/3 respondents in finance saying they plan to increase jobs, and it's across a range of functions. It's data scientists, model developers, and I think it's something we've been hearing in a lot of the roundtables we're doing. Lots of CFOs see that it's going to shift what human capital does, not replace it, and we're a long way from CFOs in particular fully trusting AI to replace humans. So it's going to be this hand-in-hand role.
Do we have a clear understanding of the effect that AI is going to have yet? It feels. I talk to a lot of companies about this, and the message that I get is we're experimenting. We still don't know. We have to spend the money because we need to find out, but we don't know what the result is. Is that how long does that phase last for?
I think it could last for a good few years. I think you've got a lot of piloting going on, but you've also got a lot of technology change happening. If you look, there's a lot of frustration around how LLMs perform, the hallucination, and every 6 months, maybe even every 3 months, we get an updated LLM. So things are evolving. We're now even moving to small language models and agents. So there's a huge amount of complexity to play out, and it's going to take a few years for that dust to settle.
Does cost need to come down? If you think about kind of the process we went through in terms of the internet and putting cable in the ground, we went through this kind of big expensive build out, then cost came down, and that allowed the industry actually to have a much wider effect and reach out into every part of the economy. Do we need to go through that kind of a process where it's not 100 cents on the dollar, it's 30 cents on the dollar, and that allows me as a business to start actually implementing this without it crippling my bottom line? Yeah,
I think you're absolutely right, and that's definitely what CFOs will be looking at, because if they go from a pilot to kind of enterprise-wide deployment, the costs multiply dramatically, and you're not going to see the short-term benefits on that. So I think you do need to see scale benefits come through in terms of lower price points for LLMs and everything to do with AI for sure.
Matt, great to see you. Great report. Thank you very much indeed. Matt Blomsom joining us from Bloomberg Intelligence. What are we going to talk about next? We're going to stay in the technology space.
We are. Tell us about these aircraft.
Would you like to go from, so this is the offering. Go from Canary Wharf to Heathrow in 12 minutes. Go from Canary Wharf to Bicester Village.
Yes.
In a kind of 6-seater eVTOL.
Right.
That's what we're going to talk about.
That's what we're talking about next. I mean, can I do that in a helicopter already?
You probably can, but it's obviously that has an emissions issue and all kinds of other issues. Domhnal Slattery, chairman of Vertical Aerospace, is about to join us. We'll talk about all of these questions next. That is what's coming up. This is Bloomberg.
Welcome back to the opening trade, 30 minutes into today's session. This is the picture across European equity markets then. With 30 minutes under our belt, we have gone absolutely nowhere. And that is entirely understandable, I suppose, because we are waiting for Fed Day, the second day of their deliberations about what they want to do with interest rates. Everyone is expecting a rate cut, of course, but how hawkish will the language around that rate cut be seems to be the question for markets. For DAX, just on the back foot, the CAC going on even more so. So the fact that the Prime Minister in Paris survives to fight another day with his budget has not lifted stocks there. The FTSE 100 outperforming a little bit. The silver trade and the energy trade seem to be putting in a little bit of that upside. Guy?
Absolutely. Let's turn our attention to the internals of these markets. 195 up, 393 down. So basically a 2-to-1 ratio in favour of the laggards today. But as Anna says, at the top line, at the index level, we're not actually seeing very much. So you're getting kind of quite a big netting effect. So that probably tells you that some of the upside are some of the heavyweights. ASML is one of them. It's up by 1%. Heavyweights. HSBC up by 1.84%. Heavyweight. Novo Nordisk, another heavyweight, up by 1.32%. So there's a number of big heavyweights stocks that are doing some heavy lifting today in terms of netting out the losers that we're seeing on the other side of the ledger. Let's talk about the downside and what we're getting there. You've got some of the pharma stocks that are under pressure. Novartis is down by 1%. Vinci is down by 2.2%. But this is the story over here that I think really stands out. Aegon is going to relist. It's going to go to America. It's another company that is leaving Europe, potentially going to America. It's going to rebrand. And the market, look at the market reaction. Like it was down by 9% at one point. Now we're seeing it down by only 8%, but that is a big market reaction against quite a significant announcement for this company, a complete kind of culture shift in terms of its narrative going forward from here. It sees the opportunity in the United States, not necessarily here in Europe, and it's moving. It's going to America as a result, Anna.
Let's get up to date on some other stories we're covering this morning then, Guy. The European Central Bank Governing Council member Domhnal Simkus says he doesn't think interest rates need to be lowered further after economic activity and inflation both turned out stronger than expected. The remarks represent a shift for Simkus, who'd said in October that there's a bigger chance of inflation falling short of the ECB's 2% goal than overshooting it. Microsoft has pledged to invest $17.5 billion in artificial intelligence and cloud computing in India over the next 4 years. Speaking this morning in Delhi, the Microsoft CEO and chairman Satya Nadella said the tech giant is to train 20 million people in India. The news comes as Amazon raised its India investment pledge this morning to $35 billion by 2030. And Bloomberg has learned that SpaceX is moving ahead with plans to go public next year. Sources say it aims to raise significantly more than $30 billion in the IPO, which would target a valuation of about $1.5 trillion. The listing would be the biggest of all time. We're told SpaceX would use some of the proceeds to develop space-based data centers of all things. Guy.
That's really got Anna scratching her head. How does that work? Why would you want to do that? We'll discuss that maybe nearer the time. Kind of feels like it's coming. Let's stay in the aerospace sector and focus more on the aero than the space side of things. The UK-based company, Vertical Aerospace, is unveiling its latest vertical takeoff and landing aircraft, aka flying taxi, today. Named, I think it's Velo. It could be Velo, but I'm going to go with Velo. It seats up to 6 people and is designed to fly up to 100 miles at speeds of 150 miles an hour. The firm says it will get passengers from London's Canary Wharf to Heathrow in 12 minutes, which sounds highly desirable. Domhnal Slattery is the chair of Vertical Aerospace and joins us around the table. Good morning.
Morning, Guy.
That's the dream. Talk us through what you're announcing today.
Well, there's actually 3 announcements today, the first being the most important. So our new aircraft, Velo.
Velo? That's
yeah.
So I got it vaguely right. Okay, good.
No, you got it spot on. So this is Europe and indeed the UK's first major innovation in aerospace in over 40 years. We're one of a very small number of eVTOL manufacturers globally. Velo will fly up to 6 passengers, 100 miles at 150 miles an hour, and importantly, at 100 times quieter than a helicopter with 0 emissions. So it's a game changer in how people will move around the mega cities of the world.
Yeah, people talk about the low altitude economy. That's the kind of that's what we're moving to. But there's some huge challenges to get us there. Notably, as you say, certification. 2028, you're thinking certification. How much money is that going to cost? Are you going to need to raise money to get there? What are the challenges to getting to certification? Because this is a whole new kind of class of aircraft that we're talking about here. Regulators are going to look super carefully at this process, and there's a number of big milestones that you have to go through. And I suspect the CAA is going to take it quite seriously.
CAA and EASA are taking it very seriously. In fact, they have really set the standards for safety in this eVTOL sector. And my board colleague, Patrick Kai, who was formerly the Director General of EASA, was the executive who actually wrote the rules.
Right.
So we now have the IP internally. So there's absolute clarity with what we need to achieve, the timeline to achieve it, and the cost to achieve it.
And do you need to raise money to get there?
Yes, so we will raise $700 million between now and the end of 2028. But the relative spend that we have is significantly lower than our US competitors, because here in the United Kingdom, we have the best aerospace engineers in the world, but they are 1/3 of the price of a similar engineer in California.
Right.
And we're also partnered with some of the top-tier aerospace firms in the world, like Honeywell, Aciturri, and that allows us to dramatically reduce our CapEx.
It sounds like they need to be asking for a pay rise. That's the first thing that I take away from that.
That's an interesting dynamic. Low production cost environment here in the UK. Good morning to you, Domhnal. Really nice to see you. Yes, I mentioned helicopters as we were running into the break in the last part of the programme, and you preempted my question by saying that these aircraft are much quieter than helicopters. But you're convinced this is going to be a large mobility market product, as opposed to just a replacement for something quite niche, which is a helicopter. What dictates that will be the case?
So just take a step back and think about the 50 megacities of the world that are growing and growing and growing, and they have literally run out of space to allow people to travel in cars effectively and efficiently. So whether it's Sao Paulo, where it can take you 2 hours to get from the airport into town, or Seoul, Korea, the same thing. So literally, the only way is up. And working with regulators globally, they've accepted that reality. So this low altitude economy is the reality of the future.
Yes, and a lot of wealthy people already make use of helicopters to do just that. So what turns this into a mass market product? It has to be a lot cheaper.
That's the key point. So we're going to democratize urban air mobility in terms of a price point. So the way we're thinking about it, and when we run the economics with our airline customers, a seat in our aircraft will cost you broadly the same as an Uber Black from, say, Central Business District to town. So in a US context, $120 from New York to JFK, Canary Wharf to Heathrow, Gatwick, or Oxford and Cambridge, as we announced earlier this morning.
It's interesting. I was talking to Joby at the Dubai Air Show, making our competitor or our price point is going to be an Uber Black. They're flying. I saw it. They flew around the Dubai Air Show with their aircraft. Do you need to catch up? Are you behind in this race?
Well, I think when you compare our aircraft with our competitors, it's a fundamentally different size machine, and people will get to see it today in Canary Wharf. So our aircraft is...
But it's not flying, is it?
So it is flying, yes.
It is,
our prototype is flying. In fact, it's flying on right here, right now. It's in its flight transition test program as we speak. But the difference between our flying and our US competitors, we do it under the oversight of the CAA. Our US competitors fly with experimental certificates. And this is a fundamentally different safety point. But the key point that I was going to make is the size of our aircraft, Guy. It's 70% larger than Joby's. 70%.
Yep.
In a Joby aircraft, there's no room for baggage. In our aircraft, you can fit 70 pounds of luggage per passenger. So it's comparing night and day, if you like, from a product perspective.
And has that been the big challenge, is being, yes, you want to be able to fly far enough, but you want to be able to carry enough weight with the battery limitations that maybe you're working with?
Yeah, so my world, Anna, is the airline world. I've spent my entire career in aviation. So about 5 years ago, we talked to 140 airlines around the world and said, what do you need? And they said 3 things, okay? The first is we need space for the passengers that's comfortable. So our aircraft is designed to take up to 6 passengers, uniquely. Secondly, we want our pilots safe.
Yeah.
So if you've been in the Joby aircraft, there's no segregation between the pilot and the passenger. That's a significant safety issue. And the third thing was our passengers are going to be coming from the airport. They need somewhere to put their luggage. And that was a big ask, 5 years ago when we were looking at the energy density of these batteries. But we cracked it. And today we're revealing Velo. It's real. It's there. And the prototype has been flying for 3 years now. And we're about to complete flight transition which is the
just in terms of that process and what we go through, my point about kind of the fact that the JB aircraft is flying, they're making flights from Jumeirah into the airport. They're starting to do those kinds of things. How far away are you from that here in the UK, and how different is the process? But they're doing it in the UAE, so
it's very different. They're flying under an experimental basis. They're not flying passengers. They won't be flying paying passengers for a very long period of time to come. So in our industry, safety is the currency of trust. Yeah. Okay, that's why aerospace is the safest industry in the world. So we're certifying to the highest safety standard here in the CAA and the EASA. We will be certified in the second half of 2028. We have got very clear milestones. We're not creating some vision or aspiration that we can do this quicker. We're going to do it safely. We're going to do it on time and on budget with the best product.
Domhnal, thank you very much. Thanks for bringing us the story. Domhnal Slattery, Chairman of Vertical Aerospace. And I think Canary Wharf got a mention there, so don't miss our conversation with the CEO of Canary Wharf Group. That conversation coming up tomorrow at 8:30 a.m. UK time. What kind of difference would this kind of accessibility make to the Canary Wharf business case?
Yeah, if it's easy to get there rather than on the Jubilee line or on the DLR, maybe that will certainly open it up to other people. Let's talk about what else is happening in the markets and figure out what is going on right now. Silver extending gains. It's broken above 60 an ounce for the first time. Momentum certainly coming from supply tightness. Bets on further monetary easing by the Fed, certainly a factor here as well. Our metals reporter Martin Ritchie joins us now from Shanghai. Martin, we're through 60. Now what?
Very good question. It's been a huge move upwards in silver. I think it's shocked some people with the extent and the speed of the rise to this level. We've been sending headlines after headlines about new record levels. We did have a conversation with Marex Group earlier today. It's a major commodities fund, and their head of analytics, Guy Wolf, said silver at these levels is probably about 15% overpriced, and perhaps a correction would be a healthy thing. There's been a lot of what we call sort of retail interest. That includes sort of wealth managers piling in to the metal. Because they see it as a bet both on more Fed easing, but also on tightness of supply in the coming year. It's still highly uncertain because these things do tend to have a lot of momentum when investors get behind them. So we'll have to see whether 60 is the last level we've seen.
Yeah, it's all those headlines keep sending, Martin. That's having something of an effect. Let me ask you about what this means for other precious metals then. Is silver's gain gold's loss, or at least gold's stability? Just looking at how gold has performed through December, it's been pretty flat.
Gold has been pretty flat. And I think that in some senses, gold and silver are sort of coming from the same dynamic. It's a lot of money sloshing around looking for a home. Gold already had big gains this year, and I think to some extent the whole precious metals complex has become a place for money to rush in when you've got those fears about the dollar, fears about fiat currencies generally, and gold is looking a lot more placid. We'll see what happens by this time tomorrow, which will be after the Fed meeting later today, obviously. If there's any surprises from the Fed in terms of perhaps their outlook for next year, we could see sort of gold perhaps break out from its recent range.
We're going to watch carefully. It's all hanging on the Fed, at least for now. Martin, thank you very much indeed. Martin Ritchie, Bloomberg Metals reporter, joining us on what we're seeing in silver. What have we got coming up for you? We need to talk about this. Australia beginning enforcing the world's first set of legislation, basically booting young people off social media sites. We're going to have the details next. The ban is a big focus globally, and we'll talk about it and figure out what the implications will be. That's next. This is Bloomberg.
Welcome back to the opening trade. We are 48 minutes into our session. It is 8:48 here in London, and European equity markets are in retreat just a little bit. We are unchanged on the FTSE 100. We're waiting for the Fed, essentially. US futures pointing a touch higher, up by 0.1% on E-minis and Nasdaq futures. Now, let's look ahead to what lies in store for the tech sector and social media in particular. In a world-first crackdown, Australians under 16 are now barred from accessing social media services like TikTok, Instagram, and Facebook. The landmark move means young people can no longer have their own accounts in a bid to curb the spread of harmful content and cyberbullying. Here's what Australia's Prime Minister Anthony Albanese had to say.
Well, this is a day in which my pride to be Prime Minister of Australia has never been greater. This is world leading. This is Australia showing enough is enough.
Australia seems to think it's setting a precedent. Let's talk about this with Bloomberg tech reporter Newly Purnell, who joins us now from Hong Kong. Newly, great to have you with us. Talk us through how this is actually going to work. How is it being enforced? Who's at fault if teens make it onto these platforms? Talk us through the detail.
Yeah, that's been a key criticism that people have leveled at this. They say, how are you going to ever keep kids who tend to be usually technically much more savvy than their parents off of some of these services? So far, what we're seeing is that the platforms are preventing new users from signing up if they enter a birth date that would put them below the age of 16. And then for some of the users who are on the platforms who have already said that they're below that age, if they said they were 13 or 14 or 15 when they signed up, they're being asked to validate their ages through other means like video selfies or uploading some sort of ID if they have one. Now, interestingly, the onus is on the tech firms. It's not parents, it's not the young users who are going to be punished. It is the tech firms. The Australian government is really clear. They say this is a problem that the tech firms need to solve, and if they don't solve it, they're going to be fined $32 million or so US. So a very interesting move that they really are leading the world here in doing something quite so bold.
It's amazing. Just simply putting in your birthday, believe you me, having dealt with teenagers and technology, that is a very, very small barrier. So how are the tech companies reacting and dealing with this?
It should come of no surprise. They hate this. They have been very vocal. You know, sometimes when companies like this are presented with new regulatory movements or new laws around the world, they kind of keep a lower profile and prefer to deal with it behind the scenes. They've come out swinging from the very beginning. Since Australia passed this rule at the end of last year, they said it's misguided. They say that the public wasn't given enough time to consult with the government on it. They say that it's going to actually push kids to darker corners of the internet that are less safe. So they're very displeased. And I think it hits at a key demographic for some of these platforms. Of course, they make money on advertising. They want not just as many people in aggregate to be on them, but they want young kids because they're going to be consumers for longer. They don't want the trend moving against them where they lose some of those network effects where if young kids get on and they delay joining, maybe they just won't join at all.
OK, Newly, what about other countries then? It's one thing this happening in Australia, but it does seem to be getting quite a lot of attention in other geographies. A lot of people watching how this goes.
Very much. It's been one of the most interesting things we've found in our reporting as we've talked to legislators around the world. We spoke with a very senior policymaker in Denmark who said, look, I'm inspired by Australia. We want to follow their lead. She said that they're working on rules for under 15s. We've seen Indonesia talk about new restrictions for under 18s. We see Brazil, a huge populous market with tons of young people on the platforms, talking about doing something similar. Some EU countries have talked about it. Singapore says it's talking to Australian counterparts about some sort of age assurance measure. So it does seem that the world is watching. They're going to see how this unfolds in Australia. But there is broad approval in Australia for it. 77% of parents, of adults overall, people say that they agree with it in Australia. So I do think we're going to see additional countries around the world try to follow Australia's lead.
Nearly, thank you very much. Bloomberg's Nearly Purnell with the latest there on that, developing regulatory activity then in Australia. Let's talk about what's coming here in the global trading day ahead. 10 a.m. UK time. Rachel Reeves testifies to the Treasury Select Committee. We heard a lot from the Bank of England yesterday. Rate decision next week. What does the budget mean for all of that? Bank of Canada rate decision later, and of course the Fed. That's 7 o'clock UK time, the Fed rate decision, and Jerome Powell's press conference at 7:30 p.m. UK time. How many of those questions will be about Fed leadership, I wonder?
How many will be about rate cuts next year? I think probably will be a significant story as other central banks around the world increasingly start to look like they're done, and then you start talking about rate hikes. Anyway, let's kind of figure all of that out. We've got some great coverage coming up, by the way, on Bloomberg around all of this, and we're going to start it, well, we've already started it, but we're going to continue it right now with Valerie Teitel joining us around the table. This is the story. Others are beginning. The signal coming globally is not of more cuts. It's a potential rate hikes coming down the pike towards us.
Yeah.
The Fed feels out of kilter with that. But I just wonder how pivotal today could be.
Well, the Fed and the Trump administration, frankly, the Fed next year is really an outlier of those, assuming there's still going to be some rate cuts, while these other central banks around the world, be it Australia, be it the ECB, be it the Bank of Japan, are talking about rate hikes. But just how far will that narrative be shifted today if we do get some more hawkish comments from Fed Chair Jay Powell? I think the market has been bracing for that in the last few sessions. We've kind of priced out the amount of cuts in 2026. We're now just penciling in 2. And the way that Powell could frame maybe a more hawkish press conference while still appeasing the doves is to say that, look, the last 2 rate reductions were all really about risk management. Yep. We want to protect the labor market. We were worried about wobbles, but that risk management exercise is coming to an end, and we need to pause. We need to slow down the pace of rate cuts while we wait for the backlog of data and while we wait to see how CPI shapes up at the early next year. A lot of inflation analysts have been pointing out that the January CPI print will be pivotal, because that in January, autos reset their prices. A lot of other goods-focused industries reset their prices in January. So if we're going to see any tariff-induced inflation, perhaps it'll come in that report.
Yeah, you do wonder if we've seen the full extent of that yet, or whether that is still to come. Now, Valerie, this time tomorrow, we will undoubtedly be talking about the Fed. Will we also be talking about Oracle earnings and Oracle CDS, which seemed to be such a talking point a couple of weeks ago when everyone was worrying about where the tech story, the AI story was going next?
Look, a big focus also on these Oracle earnings out after the bell. After their blockbuster earnings in September, the shares of Oracle have dropped around 30%, and that comes after this debt binge they've gone on in order to finance fulfilling these customer contracts. A lot of focus will be on the sales figures on their cloud unit. That'll be closely watched. But any evidence of delays in monetizing or building out what they've promised for these customer contracts will be a big focus. We have seen a few tech companies of late warn of delays in fulfilling contracts, delays in building out data centers, and those kind of hiccups can be something that could really at least crush the AI trade next year. Also, any update on financing? When it comes to what else they need to do. You know, they've already raised a huge amount via investment-grade bonds. We'll be looking for some sort of guidance on their financing needs come next year.
Could be quite nice. I'm going to bed early.
OK, so you won't be up for either of them. We'll all catch up in the morning. Valerie can't sleep. It's just not too exciting.
It's going to be a long night for everybody, I think, tonight. Hey,
Valerie, thank you very much. Bloomberg's Valerie Teitel with what you need to watch out for the rest of your trading day. A reminder, we have, of course, special coverage of the Fed decision and Chairman Powell's press conference. Tune in from 6:30 p.m. London time. We'll be up for that, surely. That's not before our bedtime. 6:30? No? You guys look
getting into that territory. It's late.
No commitment. It is dark, we'll say that. That's it for the opening trade. The Pulse is up next. This is Bloomberg.